Institutional Equity Research Report, NYSE BE, Bloom Energy Corporation, a record $1 billion quarter, a scandium lawsuit, and the AI power bottleneck.
Section 1. Executive Summary. Bloom Energy Corporation is a San Jose, California-based manufacturer of solid oxide fuel cell, or SOFC, systems, branded energy servers, and sometimes called Bloom boxes, that convert natural gas, biogas, or hydrogen directly into electricity through an electrochemical reaction without combustion. The technology traces its roots to founder Dr. K.R. Sridhar's earlier work on NASA's Mars program, where he researched generating oxygen and fuel from the Martian atmosphere. Sridhar later adapted the underlying solid oxide chemistry to generate clean, reliable electricity on Earth. The company, originally named Ion America at its 2001 founding and renamed Bloom Energy in 2006, went public on the NYSE in July 2018. In plain terms, Bloom sells modular, shipping container-sized power generators that businesses install directly on their own property, bypassing the traditional electric utility grid entirely for some or all of their power needs. Because these systems can be manufactured, delivered, and switched on in months rather than the years it can take to build new grid transmission capacity or wait in a utility interconnection queue, Bloom has become an increasingly important power source for AI data centers, which need enormous, fast-growing amounts of electricity that many local grids simply cannot deliver fast enough. That dynamic is now showing up dramatically in Bloom's financial results. Q2 2026 revenue reached $1.065 billion, the company's first ever billion-dollar quarter, up 166% year-over-year, with net income of $196.3 million versus a net loss a year earlier. Management raised full-year 2026 revenue guidance to $3.9 to $4.2 billion, roughly double 2025's $2.02 billion. At the same time, the stock has become genuinely volatile in recent weeks. A short seller report alleging undisclosed reliance on Chinese-sourced scandium, a critical fuel cell material, triggered sharp share price declines, and a securities class action lawsuit filed July 30, 2026, even as the underlying Q2 business results were exceptionally strong. Key facts at a glance. Core technology. Solid oxide fuel cells, or energy servers, convert natural gas, biogas, or hydrogen to electricity without combustion. Primary growth driver. On-site power for AI data centers facing multi-year utility grid interconnection delays. Q2 2026 revenue, $1.065 billion, plus 166% year-over-year, first billion-dollar quarter. Q2 2026 net income, $196.3 million versus a $42.6 million net loss in Q2 2025. FY 2026 revenue guidance, $3.9 to $4.2 billion, roughly double 2025's $2.02 billion. Key partnership. Brookfield Asset Management AI Infrastructure Financing Framework, expanded from $5 billion to $25 billion. Active legal risk. Securities class action filed July 30, 2026, alleging undisclosed reliance on Chinese-sourced scandium, a critical fuel cell material. This report is intended to give both professional and retail investors a clear-eyed, plain English view of Bloom Energy's business, its most recent quarterly results, and the key risks and catalysts likely to matter over the next 12 to 24 months. It is not a recommendation to buy, sell, or hold BE shares.
Investment thesis. The bull case for Bloom Energy is that it has become, in the span of roughly a year, the standard for on-site power at all data centers. validated by more than a dozen major AI infrastructure operators and headlined by Oracle's Project Jupiter, a data center power block CEO K.R. Sridhar has described as up to 2.45 gigawatts and 100% Bloom. Management says more than half of its data center backlog now comes from other hyperscalers, neoclouds, and co-location operators beyond Oracle alone, suggesting the demand story is broadening rather than concentrating in a single customer. The Q2 2026 print showed genuine operating leverage taking hold. Revenue grew 166%, while operating expenses grew only 48%, and non-GAAP operating margin expanded to roughly 22.5%. The expanded $25 billion Brookfield financing framework further de-risks how Bloom's customers pay for these systems. The bear case centers on two distinct concerns. First, valuation. At roughly 75 times 2026 non-GAAP earnings after a 174% year-to-date run, the stock already prices in a great deal of continued flawless execution, and independent fair value estimates vary enormously, from roughly $139 to $315 per share across different analytical models, reflecting genuine uncertainty about what multiple this business deserves as growth eventually normalizes. Second, and more immediate, a short seller's July 2026 report alleging Bloom misrepresented its reliance on Chinese-sourced scandium, a material used to stabilize its ceramic fuel cell electrolyte, followed by a second report alleging hardware degradation and project delays at key customers, including Oracle, triggered a securities class action lawsuit and real share price volatility, with the stock falling as much as 13% in a single session on the follow-up allegations. Thesis in one sentence: Bloom Energy has genuinely arrived as the leading on-site power solution for AI data centers, with a record billion-dollar quarter and real operating leverage to prove it. But investors are simultaneously being asked to pay a rich growth multiple, while an active securities class action and supply chain credibility questions remain unresolved. Section 3. Company Overview. Legal Entity: Bloom Energy Corporation. Headquarters: San Jose, California, North San Jose Innovation District. Exchange/ticker: NYSE BE. Founded 2001 as Ion America, renamed Bloom Energy in 2006. Founder, Chairman and CEO, Dr. K.R. Sridhar. IPO, July 2018, NYSE, raising approximately $270 to $282 million. Core technology: solid oxide fuel cells, SOFC, electrochemical, combustion-free power generation. Employees: approximately 2,127 as of FY 2024, more recent figure not verified in sources reviewed. Corporate history: Dr. K.R. Sridhar, a former University of Arizona professor, founded the company in 2001 as Ion America after his earlier work developing solid oxide fuel cell technology for NASA's Mars exploration program, which sought to generate oxygen and fuel from the Martian atmosphere. Sridhar realized the same electrochemical process could be run in reverse to generate clean, reliable electricity on Earth, and the company was renamed Bloom Energy in 2006. Co-founders included John Finnegan, Matthias Gottman, James McElroy, and D.N. Nguyen. Early venture backing came from Kleiner Perkins Caulfield and Byers and New Enterprises Associates. Corporate milestones. Date: milestone. 2001. Company founded as Ion America by Dr. K.R. Sridhar. 2006. Renamed Bloom Energy. July 2018. Completes IPO on the NYSE under ticker BE, raising approximately $270 to $282 million. 2025 reports record full-year revenue of $2.02 billion, guides FY 2026 revenue to $3.1 to $3.3 billion, backed by a record product backlog. Early 2026 announces initial $5 billion strategic AI infrastructure financing partnership with Brookfield Asset Management. July 8, 2026, short seller Hunter Brook Media publishes a report alleging Bloom sourced scandium from China via intermediary countries, despite public claims of no China dependency. Shares fall 5.7%. Mid-July 2026, Hunter Brook follow-up report alleges hardware degradation and project delays with key customers including Oracle. Shares fall as much as 13% intraday to $163.04. July 27 to 29, 2026, reports record Q2 2026 results, $1.065 billion revenue, and raises full-year guidance. Brookfield partnership expanded from $5 billion to $25 billion. July 30, 2026, securities class action lawsuit Nevins v. Bloom Energy Corporation filed in the U.S. District Court of the Northern California District over the scandium supply chain disclosure allegations. Section 4. Business Model. Bloom designs, manufactures, sells, and installs energy server systems for customers who want reliable on-site electricity generation without depending entirely on the local utility grid. Revenue comes primarily from two sources: product sales, the upfront sale or lease of energy server hardware, which made up $935.4 million of Bloom's $1.065 billion Q2 2026 revenue, and services, ongoing maintenance and performance contracts on installed systems, which management has highlighted as a high-margin, recurring revenue stream that has improved substantially since the company's 2018 IPO. The company's core electrochemical technology uses a solid ceramic electrolyte stabilized with a rare earth material called scandium to convert fuel, typically natural gas, though the systems can also run on biogas or hydrogen, directly into electricity through a chemical reaction rather than by burning the fuel to spin a turbine. This combustion-free process produces meaningfully lower nitrogen oxide and sulfur oxide emissions than traditional gas turbines or diesel generators, and the modular factory-built energy server platform allows systems to be manufactured, shipped, and installed in a matter of months, a critical advantage for data center customers facing multi-year waits for new utility grid connections. How to think about it. Think of Bloom's core value proposition as selling speed and certainty. A data center operator that needs 100-plus megawatts of new power capacity might wait years for a utility to build new transmission and generation infrastructure, but can install Bloom's factory-built modular energy servers on its own site in a fraction of that time, even though the electricity itself typically costs more than grid power. Section 5. Products and Services. Product/service. Description. Bloom Energy Server. The company's flagship product, modular, shipping container-scale solid oxide fuel cell systems that convert natural gas, biogas, or hydrogen into electricity on-site without combustion, the core platform being deployed at AI data centers. Hydrogen fuel cells. Fuel cell systems adapted to run directly on hydrogen rather than natural gas, positioning Bloom for a longer-term transition toward lower carbon fuel sources as green hydrogen infrastructure matures. Bloom electrolyzers. Equipment that uses electricity to split water into hydrogen and oxygen, the reverse of the fuel cell process, allowing Bloom to participate in both hydrogen production and hydrogen power generation. Service and maintenance contracts. Ongoing performance and maintenance agreements on installed energy server fleets. management has specifically highlighted a 43 percentage point improvement in service gross margin since the company's 2018 IPO. The single largest current commercial application driving Bloom's growth is behind-the-meter power for AI data centers, installations built directly on a customer's property to serve its own load, bypassing the public grid. CEO K.R. Sridhar has specifically cited Oracle's Project Jupiter as a flagship example, describing it as a data center power block that could reach up to 2.45 gigawatts of capacity, and stating it would be 100% Bloom. How to think about it? Scandium, the rare earth material at the center of Bloom's current legal controversy, Section 13, isn't a minor input. It's a dopant used to stabilize the zirconia-based ceramic electrolyte at the heart of every energy server, meaning questions about the security and transparency of Bloom's scandium supply chain go directly to the core of its manufacturing process, not a peripheral component.
Section 06. Industry Overview. The U.S. electric grid is facing a historic surge in demand from AI data centers at precisely the moment when building new transmission lines and power plants has become slower and more difficult, creating what CEO K.R. Sridhar has called an existential necessity around time to power rather than merely a procurement consideration. Utility interconnection queues in many regions now stretch multiple years, pushing data center developers to increasingly consider on-site, behind-the-meter generation as the only realistic way to bring new AI infrastructure online on the timelines their businesses require. This dynamic has fueled a broader re-rating of the entire fuel cell and distributed power sector in 2026, with Bloom Energy, Fuel Cell Energy, and Plug Power all posting substantial year-to-date stock gains, 174%, 181%, and 14% respectively, as of a recent snapshot, on the AI data center power thesis, alongside renewed attention to traditional on-site generation equipment makers like Caterpillar and Generac, and gas turbine manufacturers such as GE Vernova and Siemens Energy, all of which are seeing increased demand from the same underlying grid capacity shortfall.
Section 7. Market Opportunity. Bloom's immediate opportunity is capturing a larger share of the on-site power build-out for AI data centers, a market management describes as effectively demand-constrained on the supply side, rather than order-constrained, meaning Bloom's growth is currently limited more by how fast it can manufacture and deploy energy servers than by a shortage of customers wanting them. The company is in the process of expanding manufacturing capacity from 1 gigawatt to 2 gigawatts of annual output by the end of 2026, directly targeting this capacity constraint. Beyond data centers, Bloom's broader opportunity includes industrial and commercial customers seeking resilient, lower-emission on-site power, and a longer-term hydrogen fuel cell and electrolyzer business that could benefit from continued policy and cost curve support for green hydrogen. Management has emphasized that its current data center backlog is no longer concentrated in a single customer relationship. Well more than half reportedly comes from hyperscalers, neoclouds, and co-location operators beyond Oracle, suggesting the addressable opportunity is broadening across the AI infrastructure ecosystem rather than depending on any one buyer. How to think about the opportunity. The most important number to watch going forward may not be revenue growth itself, but manufacturing capacity. If Bloom is genuinely supply-constrained rather than demand-constrained, then the pace of its 1 gigawatt to 2 gigawatt capacity expansion becomes the real ceiling on how fast the company can grow from here. Section 8. Competitive Landscape. Competitor. Listing. Positioning. Fuel Cell Energy. NASDAQ. FCEL. Direct fuel cell competitor, but vastly smaller in scale, roughly $35 to $36 million in quarterly revenue and still gross margin negative versus Bloom's $1.065 billion and positive operating income. recently announced a strategic agreement for up to 380 megawatts of clean on-site power for data centers, and has also seen substantial 2026 stock gains on the same AI power theme. Plug Power, NASDAQ, PLUG, hydrogen-focused fuel cell and electrolyzer company, roughly $164 million in quarterly revenue, plus 22% year-over-year, but still unprofitable, with a different technology and customer focus, heavily weighted toward hydrogen fueling in materials handling than Bloom's data center-oriented SOFC systems. Caterpillar and Generac, NYSE CAT and NYSE GNRC, compete more broadly through traditional gas and diesel generators and on-site power equipment, larger overall scale, but without Bloom's continuous lower-emission, combustion-free technology differentiation. Chinese competitors, various, flagged by independent analysis as a longer-term pricing and technology threat, though not yet a major factor in Bloom's core U.S. data center market as of this report's date. Where Bloom stands. Bloom holds an estimated 55 to 65% share of the stationary solid oxide fuel cell market, per one independent industry estimate as of 2025, and has become, per management's own characterization, the standard for on-site power solutions in the AI data center market within roughly a year. Its combination of scale, positive operating income, and validated deployments with major hyperscalers gives it a meaningfully stronger competitive position than fuel cell energy or plug power today, though larger diversified players like Caterpillar, GE Vernova, and Siemens Energy retain far greater overall manufacturing scale and could increasingly compete for the same data center power opportunity. Section 9. Management Team. Dr. K.R. Sridhar, Founder, Chairman, and Chief Executive Officer, has led Bloom Energy since founding the company in 2001, following earlier work as a University of Arizona professor developing solid oxide fuel cell technology for NASA's Mars exploration program. Faced criticism from some analysts in the early 2020s for over-promising on the company's growth trajectory, criticism that independent analysis suggests has since been largely vindicated by Bloom's successful pivot into AI data center power. On the Q2 2026 earnings call, Sridhar emphasized that the company is not capacity or order constrained, highlighted that data center customers can realize $1 to $2 billion of revenue they might otherwise miss out on while waiting for utility power, and pointed to a 43 percentage point improvement in service gross margin since Bloom's 2018 IPO as evidence of the business's long-term operational maturation. Sridhar is also named as a defendant in the pending securities class action lawsuit discussed in Section 13. Simon Edwards, Chief Financial Officer. On the Q2 2026 earnings call, Edwards highlighted that operating expenses grew 48% year-over-year, while revenue grew 166%, describing this as a structural operating leverage tied to Bloom's relatively fixed research, development, and G&A cost base, and stated that this leverage should continue as the company scales. Edwards also addressed customer project delay risk directly, noting that Bloom's contracts include strong protections, its equipment is flexible for redeployment to other customers if needed, and financial partners are contractually obligated to take delivery of ordered systems, which management says mitigates the company's financial exposure to any single project's timeline.
Section 10. Financial Performance. Metric. Q1 2026, Q2 2026. Revenue. $751.1 million, plus 130.4% year-over-year. $1,065.4 million, plus 165.5% year-over-year, plus 42% QOQ. Product revenue, $653.3 million, then all-time high, $935.4 million, plus 215.4% year-over-year. Non-GAAP gross margin, information not specified in this source set, 34.3% versus 28.2% year-over-year. Non-GAAP operating margin, 17.3%, approximately 22.5% implied by non-GAAP operating income of $239.6 million. Non-GAAP diluted EPS, 44 cents versus 3 cents year-over-year, 78 cents versus 10 cents year-over-year. In plain terms, Bloom's growth accelerated significantly from Q1 to Q2 2026, with revenue growth climbing from 130% to 166% year-over-year, and profitability improving even faster than revenue, a genuine sign of operating leverage taking hold as the company scales its now larger manufacturing base across a relatively fixed cost structure. For the first 6 months of 2026, Bloom generated $1,816.4 million in revenue and $266.9 million of net income attributable to common stockholders, with diluted EPS of 85 cents per share, compared to a 29-cent per share loss in the first half of 2025. Balance sheet. As of June 30, 2026, Bloom held $2,688.5 million in cash, cash equivalents, and restricted cash against total outstanding recourse debt of $2,475.4 million, with a $600 million revolving credit facility remaining entirely undrawn. First half 2026 operating cash flow reached $300 million, a meaningful improvement reflecting both revenue growth and improving working capital efficiency as the business scales. Section 11. Detailed analysis. Latest quarterly earnings, Q2 2026. Revenue. Total revenue was $1,065.4 million, up 165.5% year-over-year from $401.2 million and up 42% sequentially from Q1 2026, Bloom's first ever billion-dollar quarter, beating the $827.58 million analyst consensus by roughly 29%. Product revenue specifically reached $935.4 million, up 215.4% year-over-year, reflecting accelerating energy server deployments tied to AI data center demand. Gross margin. GAAP gross margin expanded to 33.4%, up from 27.7% a year earlier. Non-GAAP gross margin reached 34.3%, up from 28.2%. This margin expansion reflects a combination of higher manufacturing volume, improved factory utilization, and a growing higher margin service revenue base attached to Bloom's expanding installed fleet. Operating income. GAAP operating income was $182.2 million, a dramatic turnaround from a $3.5 million operating loss in Q2 2025. Non-GAAP operating income rose to $239.6 million from $28.6 million a year earlier, an implied non-GAAP operating margin of roughly 22.5%, up sharply from just under 7% in the prior year quarter. Net income. Net income attributable to common stockholders was $196.3 million, compared with a $42.6 million net loss in Q2 2025, a swing of roughly $239 million year-over-year. Adjusted EBITDA rose to $253.4 million from $41.2 million. EPS. GAAP diluted EPS was $0.62 versus a negative $0.18 per share a year earlier. Non-GAAP diluted EPS was $0.78, up from $0.10 in Q2 2025, comfortably ahead of analyst expectations for the quarter. Cash flow.
Operating cash flow was $226.4 million for the quarter, compared with a $213.1 million use of cash in Q2 2025, a swing of roughly $440 million year over year, and a clear sign of the business converting its rapid revenue growth into genuine cash generation rather than merely accounting profit. Balance sheet. Cash, cash equivalents, and restricted cash totaled $2,688.5 million as of June 30, 2026. Total outstanding recourse debt stood at $2,475.4 million, with a $600 million revolving credit facility remaining fully undrawn, giving the company meaningful additional financial flexibility beyond its cash balance if needed. Guidance. Management raised full-year 2026 revenue guidance to $3.9 to $4.2 billion from a prior $3.4 to $3.8 billion range, representing approximately 100% growth over full-year 2025 revenue of $2.02 billion. The company guided full-year non-GAAP gross margin to approximately 34%, non-GAAP operating income to $800 to $900 million, implying an operating margin of roughly 21%, and non-GAAP diluted EPS to $2.55 to $2.85. Management commentary.
CEO Sridhar stated the company is not capacity or order constrained, emphasizing that data center operators who wait for utility power rather than deploying Bloom systems may forego $1 to $2 billion of revenue they could otherwise capture, and noted the company has visibility into its currently expected deployments. CFO Edwards attributed the gap between 48% OPEX growth and 166% revenue growth to structural operating leverage from Bloom's largely fixed R&D and G&A cost base, and stated this dynamic should continue as the company scales further. On customer concentration and project delay risk, Edwards said Bloom's 2026 revenue guidance is not dependent on any single project, citing strong contractual protections, redeployable equipment, and financial partners contractually obligated to take delivery. Key changes versus previous quarter. Revenue growth accelerated from 130% year-over-year in Q1 2026 to 166% in Q2 2026, crossing the $1 billion quarterly revenue mark for the first time. Non-GAAP operating margin expanded from 17.3% in Q1 2026 to an implied negative 22.5% in Q2 2026, evidence of accelerating operating leverage. Full-year 2026 revenue guidance was raised for at least the second time in 2026, from an initial $3.1 to $3.3 billion at the Q4 2025 report to $3.4 to $3.8 billion, and now to $3.9 to $4.2 billion. The Brookfield Asset Management AL Infrastructure Financing Partnership was expanded five-fold from $5 billion to $25 billion. Despite the strong beat and raise quarter, shares fell in the following days as part of a broader fuel cell sector pullback and amid the unresolved scandium supply chain litigation discussed in Section 13.
Section 12. Growth Drivers. AI Data Center Power Bottleneck. Multi-year utility grid interconnection delays continue pushing hyperscalers, AI labs, and co-location operators toward on-site power solutions like Bloom's, with management describing time to power as an existential business necessity for these customers, not merely a preference. Manufacturing capacity expansion. Bloom's planned expansion from 1 gigawatt to 2 gigawatts of annual manufacturing capacity by the end of 2026 directly addresses management's stated supply-side growth constraint, not demand-side growth constraint. Broadening customer base beyond Oracle. Management's disclosure that well more than half of the data center backlog now comes from hyperscalers, neoclouds, and co-location operators beyond Oracle's Project Jupiter suggests reduced single customer concentration risk and a genuinely expanding addressable market. Expanded Brookfield financing partnership. The five-fold expansion of Brookfield's AI infrastructure financing framework from $5 billion to $25 billion gives Bloom's customers a much larger pool of project financing capacity, potentially accelerating deal conversion from backlog to installed revenue-generating systems. Growing high-margin service revenue. Management cited 43 percentage point improvement in service gross margin since the 2018 IPO reflects a maturing, increasingly profitable recurring revenue stream layered on top of Bloom's core product sales business.
Section 13. Key risks. Active securities class action over scandium supply chain disclosures. A securities class action lawsuit, Nevins v. Bloom Energy Corporation, filed July 30, 2026, in the U.S. District Court for the Northern District of California, alleges that Bloom and certain executives, including CEO K.R. Sridhar, made false or misleading statements denying reliance on China-sourced scandium, specifically citing a Q1 2025 earnings call statement that there is no China supply chain for us, and a July 2025 Form 10Q statement that the company's supply chain does not have significant exposure to China. This suit remains unresolved as of this report's date and could result in financial liability, reputational harm, or further disclosure-related scrutiny. Short seller allegations of hardware degradation and project delays. Beyond the scandium sourcing allegations, Hunter Brook Media's follow-up report alleged hardware degradation issues and project delays at key customers including Oracle, allegations that, if substantiated, would bear directly on the durability of the AI data center growth narrative central to Bloom's current valuation. These allegations have not been independently verified in the sources reviewed for this report and are disputed by the company. Extreme valuation and stock price volatility. BE shares are up 174% year-to-date as of a recent snapshot and trade at approximately 75 times 2026 non-GAAP earnings, a rich multiple that assumes continued exceptional execution. Independent fair value estimates vary dramatically across different analytical models, from roughly $139 to $315 per share, reflecting genuine, unresolved disagreement about what growth rate and multiple this business can sustainably command. The stock has already demonstrated its capacity for sharp single-session moves, falling as much as 13% intraday on the Hunter Brook follow-up report alone. Customer and project concentration. While management states more than half of the backlog now comes from customers beyond Oracle, Oracle's Project Jupiter remains a named, high-profile anchor project. Any disruption, delay, or scaling back of this or other major projects could disproportionately affect near-term results and investor sentiment.
4. Historical disclosure and governance scrutiny. Bloom has faced historical media investigations, including prior Forbes and Axios reporting into its accounting and disclosure practices dating to its earlier years as a public company. While independent analysis suggests governance and transparency have improved since, most notably a shift away from complex special-purpose vehicle accounting structures that clouded the company's early public disclosures, the current scandium litigation shows that supply chain and disclosure accuracy questions remain a live risk area for the company. A. Intensifying competition. Fuel Cell Energy has announced its own data center power agreements. Traditional gas turbine incumbents like GE Vernova and Siemens Energy are increasingly courted by data center developers, and independent analysis has flagged Chinese competitors as a potential longer-term pricing threat, all of which could pressure Bloom's growth rate or margins over time. 4. execution risk on manufacturing capacity expansion. Bloom's growth outlook depends on successfully doubling manufacturing capacity from 1 gigawatt to 2 gigawatts by end 2026. Delays or cost overruns could constrain the company's ability to convert backlog into recognized revenue on the timeline the market expects.
Section 14. Valuation. Metric. Value. Recent share price. Approximately $235, varies by date or source amid recent volatility. Year-to-date return, plus 174% as of a recent snapshot. Forward PE, 2026 non-GAAP EPS guidance, 75 times approximately. FY 2026 non-GAAP diluted EPS guidance, $2.55 to $2.85. Independent fair value estimates range across models, $139 to approximately $315. Sell-side price targets, recent. Mizuho, $242, buy, post-Q2 upgrade. Market beat consensus, approximately $246. Bloom Energy's valuation reflects a market pricing in continued exceptional growth. At roughly 75 times forward non-GAAP earnings, the stock trades at a substantial premium, even after accounting for its genuinely strong operating leverage and raised guidance. The wide dispersion in independent fair value estimates from roughly $139 to $315 per share illustrates just how sensitive different valuation models are to assumptions about long-term operating margin. One analysis assumes eventual operating margins moving toward roughly 13–14% versus the 21% implied by current FY 2026 guidance, and the multiple investors should ultimately pay for that earnings stream once hypergrowth normalizes. Mizuho's Maheep Mandloy upgraded the stock to buy with a $242 price target following the Q2 print, citing operating leverage emerging faster than expected and viewing the post-earnings pullback as an attractive entry point. Other market participants remain more cautious given the pending litigation and the stock's already substantial 2026 run-up. Section 15. Upcoming catalysts. Catalyst. Expected timing. Why it matters. Q3 2026 earnings report. Information not publicly available, typically late October. Will test whether the raised FY 2026 guidance and margin trajectory hold up and provide an updated read on manufacturing capacity expansion. Securities class action lead plaintiff deadline. September 28, 2026, marks a key procedural milestone in the pending Scandium disclosure litigation. The case's progress thereafter could remain an overhang on sentiment. 1 GW to 2 GW manufacturing capacity expansion completion by end of 2026. Directly determines how much of the current backlog Bloom can convert into recognized revenue over the following year. Further Oracle Project Jupiter deployment milestones. Ongoing. Progress updates on this flagship publicly named 2.45 GW project will be closely watched as a bellwether for execution. Additional Brookfield-financed project announcements. Ongoing. Would signal how quickly the expanded $25 billion financing framework is converting into actual installed capacity. Any company response or resolution regarding hardware degradation allegations. Ongoing. Could meaningfully affect investor confidence in the durability of the AI data center growth narrative if further substantiated or refuted. Section 16. Long-term outlook.
Bloom Energy's long-term outlook depends on whether the current AI data center power bottleneck represents a durable multi-year structural demand driver or a shorter-term dislocation that eases as utilities eventually catch up on grid capacity. If the grid interconnection backlog remains a persistent, years-long constraint, which most independent industry analysis currently expects, Bloom's combination of manufacturing scale, positive operating income, and now broadening hyperscaler customer base positions it as a genuine long-term beneficiary, particularly if it can complete its capacity expansion to 2 gigawatts and continue converting backlog into recognized revenue at the pace management now expects. The company's path also depends on resolving, or at minimum containing, its current legal and reputational overhang. The outcome of the securities class action and any further developments regarding the hardware degradation and supply chain allegations will likely shape how much of a valuation premium investors are willing to sustain, independent of the underlying operating results. Longer term, Bloom's hydrogen fuel cell and electrolyzer businesses, while currently a smaller part of the overall story, could provide additional multi-year growth optionality as green hydrogen infrastructure and policy supports continue to develop. Section 17. Bull Case. Bull Case Summary. Bloom successfully completes its manufacturing capacity expansion to 2 gigawatts on schedule, converting its broadening, now diversified backlog into continued triple-digit revenue growth. Operating leverage keeps expanding as management has described, pushing margins toward or beyond the high end of FY 2026 guidance. The expanded $25 billion Brookfield financing framework accelerates project conversion across multiple hyperscaler and neo-cloud customers beyond Oracle. The securities class action is resolved favorably or immaterially for the company, and the hardware degradation allegations prove unsubstantiated. And the market comes to view Bloom's roughly 21% operating margin trajectory as sustainable, supporting a valuation multiple toward the higher end of independent fair value estimates, $315. In this scenario, Bloom could solidify its position as the standard-bearer for on-site AI data center power for years to come. Section 18. Bear Case. Bear Case Summary. The securities class action or further investigative reporting substantiates meaningful disclosure failures around Bloom's scandium supply chain, resulting in significant financial liability, reputational damage, or forced supply chain restructuring at higher cost. The hardware degradation allegations prove at least partially accurate, denting confidence in Bloom's core product reliability and slowing new customer adoption. Manufacturing capacity expansion to 2 gigawatts is delayed or faces cost overruns, constraining revenue conversion from backlog. Utility grid capacity additions accelerate faster than expected, easing the interconnection bottleneck that currently drives urgent demand for on-site power. And the market re-rates the stock toward the lower end of independent fair value estimates, $139, as growth normalizes and the current 75x earnings multiple compresses. In this scenario, BE shares could see substantial, sustained downside from current levels, even if the underlying business continues growing at a healthy, if decelerating pace. Section 19. Final Investment Conclusion. Bloom Energy's Q2 2026 results were, by almost any measure, exceptional. The company's first billion-dollar quarter, net income that swung from a loss to nearly $200 million, and full-year guidance raised for at least the second time in 2026, all backed by tangible validation from major AI infrastructure operators and a dramatically expanded $25 billion Brookfield financing relationship. The core investment thesis that Bloom has become a genuine bottleneck solver for AI data centers facing years-long utility grid delays is showing up clearly and consistently in the company's actual financial results, not just in management's narrative.
At the same time, investors evaluating BE today cannot separate that operating strength from two live, unresolved sources of uncertainty: a securities class action alleging the company misrepresented its reliance on Chinese-sourced scandium, and unverified short seller allegations of hardware degradation at key customer sites. Both introduce genuine tail risk that sits alongside an already rich valuation at roughly 75 times forward earnings following a 174% year-to-date stock run. The wide dispersion in independent fair value estimates from roughly $139 to $315 per share reflects just how much the eventual outcome depends on questions: sustainable operating margin, litigation resolution, and the durability of the AI data center demand cycle that remain genuinely open as of this report's date.
Bottom line, Bloom Energy offers investors direct exposure to one of the clearest, best validated beneficiaries of the AI data center power bottleneck, with financial results that have moved decisively from promise to proof, but at a valuation and amid active litigation that leaves little room for disappointment on either the operational or legal fronts. This report does not constitute a recommendation to buy, sell, or hold BE shares. Readers should review the company's complete SEC filings and consult a qualified financial advisor before making any investment decision.